Hello, welcome to our comprehensive buyer's course. We are so excited to help you on your home buying journey. Over the course of this module, you will learn budgeting for a home purchase, understanding credit scores and mortgage pre-approval, and calculating down payments and closing costs. Assessing your financial health. Before diving into the home buying process, the first step is to assess your overall financial health. Start by reviewing your income, debts, and savings. This will give you an idea of how much you can afford to spend on a home. You should aim to spend no more than 28 to 30% of your gross monthly income on housing costs. This includes the mortgage, taxes, and insurance. And your total debt, including the mortgage and other loans, should ideally be no more than 36 to 43% of your gross monthly income. Creating a home buying budget. Establishing a realistic budget is crucial. Start by determining your down payment amount, which typically ranges from 3% to 20% of the home's purchase price. In addition to the down payment, factor in closing costs, moving expenses, and ongoing costs of home ownership. This can include utilities, property taxes, and homeowner's insurance. Having a comprehensive budget will ensure you don't stretch your finances too thin and avoid any surprises along the way. Emergency fund for home ownership. Home ownership comes with unexpected costs, from maintenance and repairs to seasonal utilities. Before buying, ensure that you have an emergency fund set aside, ideally covering 3 to 6 months worth of living expenses, including the costs associated with maintaining your new home. This fund will give you peace of mind in case of unexpected repairs or life changes after you move in. Understanding your monthly housing costs. It's important to understand that your monthly mortgage payment will include more than just the loan principal and interest. You'll also be responsible for property taxes, homeowner's insurance, and possibly private mortgage insurance, also known as PMI, if your down payment is less than 20%. Be sure to budget for these extra costs as they can significantly impact your monthly payment. Long-term financial planning. Buying a home is a long-term financial commitment. You'll need to think beyond the initial purchase and consider your financial goals. How will a mortgage affect your ability to save for retirement or other major life events? It's essential to evaluate the long-term affordability of your home purchase and how it fits into your overall financial picture. What is a credit score and why it matters? Your credit score is a numerical representation of your financial reliability and is a critical factor in the mortgage approval process. The higher your score, the better the mortgage terms you'll be offered. A good credit score, typically 620 or higher, can help you secure affordable interest rates, while a lower score may result in higher rates or even difficulty obtaining a mortgage. How your credit score impacts loan eligibility. Lenders use your credit score to assess the risk of lending to you. A higher credit score indicates that you're more likely to repay your mortgage on time, making you eligible for lower interest rates and better loan terms. A lower credit score may lead to higher interest rates or the need for a larger down payment. It's essential to know your credit score before applying for a mortgage so that you're prepared to make the best financial decision. Steps to improve your credit score. If your credit score is lower than you'd like, there are steps you can take to improve it before applying for a mortgage. Start by paying down outstanding debts, avoiding new credit inquiries, and correcting any errors on your credit report. Aim for a credit score of at least 620 to 700 for conventional loans, but higher scores, 750 and over, will give you access to the best mortgage rates. The importance of mortgage pre-approval. Getting pre-approved for a mortgage is one of the most important steps in the home buying process. It involves submitting financial documents such as income, tax returns, and the credit report to a lender who will evaluate your eligibility for a loan. Pre-approval not only gives you a clear idea of how much you can afford to spend on a home, but also shows sellers that you are a serious buyer. Pre-approval can give you a competitive edge, especially in a seller's market. Difference between pre-qualification and pre-approval. While pre-qualification is a less formal process where you provide basic financial information to get an estimate of how much you can borrow, pre-approval is a more thorough process. It involves a credit check and a deeper look at your finances, which gives you a more accurate idea of your budget. Pre-approval is more reliable than pre-qualification and will make you a stronger candidate while submitting offers on a home. Down payment requirements. The down payment is the upfront cash you pay towards the purchase of your home. Typically, down payments range from 3% to 20% of the home's purchase price. For first-time home buyers, there are programs that offer down payments as low as 3%, such as an FHA loan, while conventional loans often require 5% or more. If you can afford a larger down payment, such as 20%, you'll avoid private mortgage insurance, also known as PMI, which can save you money on monthly payments. How much should you put down? While the minimum down payment for some loans may be as low as 3%, putting down more than the minimum offers several benefits. A larger down payment can lower your monthly mortgage payment, reduce your loan balance, and help you build equity faster. However, it's essential to balance this with your overall savings and budget. Don't deplete your emergency fund just to make a larger down payment. Understanding closing costs. In addition to the down payment, you'll need to budget for closing costs, the fees associated with finalizing your home purchase. These costs typically range from 2% to 6% of the home's purchase price and may include appraisal fees, title insurance, home inspection fees, loan origination fees, and attorney fees if applicable. It's crucial to plan for these costs upfront to avoid any surprises when it's time to close. Common closing costs. Common closing costs include fees for the appraisal, credit report, title search, and agents involved. Some closing costs are negotiable, and in some cases, the seller may agree to pay a portion of the buyer's closing costs. Your lender should provide a loan estimate within 3 days of your application, which outlines your expected closing costs so you can better prepare. Negotiating closing costs. As a buyer, you may have some room to negotiate closing costs. In a buyer's market, sellers might offer to cover some of the closing costs to make your offer more attractive. Additionally, some lenders may offer to cover or roll some of the costs into the loan, reducing the amount you need to pay at closing. Be sure to ask your real estate agent and lender about options for reducing or negotiating closing costs. Congratulations on completing Module 2 of our comprehensive buyer's course. We hope you have found this information helpful for your home buying journey. If you have any further questions about the topics covered in this video, please feel free to reach out to us. As always, thank you for landing with the Landrys. See you soon.